I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, September 19. Broad inflationary pressures are compelling the Federal Reserve to continue tightening, suggesting that reaching the holy grail of 2% inflation will be a long and arduous quest. However, although bearish sentiment is rising on Wall Street, I continue to see glimmers of hope that inflation has maybe peaked and we face better quarters ahead. If you look closer at the latest inflation data, behind the admittedly disturbing picture of still elevated inflation, you can detect many encouraging signs. The S&P 500, well, it did finish last week 4.8% lower, with most of the loss stemming from a 4.3% sell-off on Tuesday in the wake of an unexpectedly hot inflation report for August. All of the major indices have now racked up losses in 4 of the past 5 weeks. The following table tells the grim story. As you can see, the technology-heavy Nasdaq got clobbered the worst last week as expectations of rising interest rates diminished the growth prospects of tech stocks. The value of any asset is its future cash flows discounted at the existing interest rate. Growth stocks, e.g. high-flying tech shares, have higher expected future earnings. When interest rates are falling, those future earnings are worth more, and the converse is true when rates are rising. Recession fears also push down the price of crude oil, which is good news on inflation, but also an indication that economic projections are getting more pessimistic. Another catalyst for last week's swoon in equities was a bleak forecast from FedEx, whose shares tanked after management issued an earnings warning. FedEx is considered an economic bellwether, and the package delivery giant is shuttering locations and laying off workers due to a forecasted slump in demand. Also contributing to the bearish mood last week was a statement from General Electric that the industrial conglomerate was experiencing higher costs due to supply chain woes. However, evidence is mounting that transportation bottlenecks and supply chain problems caused by the Ukraine war and the pandemic are significantly easing. Take a look at the following chart. The latest data for August show that shipping costs are dramatically falling, a trend that should soon show up within the next round of inflation reports. Helping reduce shipping costs is the softening demand for goods, especially consumer discretionary items, which relieves a large part of the burden on supply chains. Also easing inflationary pressures is the falling cost of prices for inputs, as shown by this chart. The CPI numbers lately have been harder than expected, sure, but leading indicators on inflation, such as input and shipping costs, are dropping. That strongly suggests we'll start to get better news on inflation down the road. Some of the worst fears about inflation revolve around expectations. Inflation becomes stubbornly high over a prolonged period of time when consumers start to expect inflation and behave accordingly. That's when inflation becomes entrenched and a self-fulfilling prophecy. But on that score, we're getting better news too. Take a look at this chart. According to the New York Federal Reserve's latest inflation survey released last Monday, 3-year inflation expectations dropped to 2.8% in August from 3.2% the previous month. U.S. inflation is expected to average 5.7% for all of 2023 and shrink to 2.8% 3 years out, largely thanks to falling gasoline prices. That said, the Federal Reserve has reiterated that fighting inflation is job one, and with the latest hot readings of price increases, the expectation is that tightening will continue at an aggressive pace, as this chart on yields shows. The bond market currently estimates that the U.S. Central Bank will cease rate hikes at about 4.5% from 4.0% before, with the last hike occurring in March 2023. Accordingly, the 2-year Treasury yield has reached a new cycle high, and the 10-year is back near its mid-June high. Now let's take a look at the week ahead. In the coming days, the key economic reports to watch include housing starts Tuesday, existing home sales and the Fed's statement Wednesday, initial jobless claims Thursday, and the S&P manufacturing and services PMIs Friday. The biggest news of the week, of course, will be the Fed's announcements on Wednesday at the conclusion of its 2-day meeting. Wall Street expects the Fed to hike rates by another 75 basis points, 0.75%, when it meets this week, bringing the Fed funds rate to between 3% and 3.25%. The upshot? I think it's likely that the stock market rally has merely paused rather than start a new leg down. Markets should eventually start bouncing back as central banks become less hawkish in 2023. Stay patient and use the dips to pick up quality investments at bargain prices. Meanwhile, there are investing methods that generate income regardless of the risks I've just described. Consider Rapier's Income Accelerator. Helmed by my longtime colleague Robert Rapier, this premium publication consistently makes money for its followers, no matter what Mr. Market throws at us. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching.